Episode 9 ended with the first genuinely profitable strategy over the 3 years. 1 hour time frame, 50 by 200 SMA, plus $458, 4.6% return. After 8 episodes of failure, this felt like the moment. But Claude flagged two numbers at the end of that episode that I couldn't stop thinking about: 8.5% max drawdown and 1.5 trades per month. Today, we find out if those two numbers are a problem or a deal breaker. Here's why these numbers matters. Every prop firm has rules. The 5 percenters, the firm we are targeting, has specific limits. Maximum drawdown, 10% from the initial balance. On a $5,000 account, that's $500. Drop below 4,500 at any point, the challenge fails instantly. No second chances. Daily loss limit, 5%, calculated from the previous day's highest balance or equity. Profit target, 10%. On $5,000 account, that's 500 to pass. And here's something that actually surprised me. No time limit. None of the four program, the 5%ers offers a deadline. So our 1.5 trades per month isn't actually a problem. Slow and steady is fine. But that 8.5% drawdown on a $500 account, that's $425. We'd be sitting at 85% of our total allowed drawdown from a single event. That's too close. So we asked Claude, why is the drawdown so high in the first place? The answer was in how the strategy exits trades. The original 1 hour strategy had no fixed stop loss. It only exited when the opposite crossover fired, which meant some losing trades ran 200, even 300 pips against us before the strategy finally recognized the trend had reversed. One trade alone lost $335. So the question became simple: what happens if we add a fixed stop loss and take profit to every trade? Same entry logic, same 50 by 200 SMA crossover, same RSI filter. Just add stop loss 50 pips, take profit 100 pips. A clean 2 to 1 risk reward on every single trade. While this runs, let me explain what we are trading away here. Without fixed stop loss or take profit, winning trades can run as long as the trade continues. Some of those trades made 500, 600 in a single position. With fixed take profit at 100 pips, every winning trade is capped. Even if the trend continues for another 300 pips after we exit, we don't capture it. The question is, does capping the losses save more than capping the wins costs us? And here's the answer. Let me walk through what changed. Total trades identical, 55 and 55. The entry logic didn't change at all. Same signals, same timing. Win rate dropped slightly, 43.6% to 41.8%. A small decrease, but total profit up by $458 to 627. That's $169 better. And the number that matters more for the prop firm: max drawdown, 8.5% to down to 2.4%. Let me say that again: 8.5% down to 2.4%. On a $5,000 account, that's the difference between $425 of risk and $120 of risk. We went from sitting at the edge of disqualification to having massive breathing room under the $500 limit. Here's the exit breakdown: 20 trades hit take profit, 28 hit stop loss, 7 exited on the original signal based rule. The worst trade in the original strategy was minus $335. One position that ran against us for hundreds of pips before the strategy gave up on it. With a 50 pips stop loss, that same trade would have closed at minus 50. That single change, capping at worst case, is what took the drawdown from 8.5% to 2.4%. But there's a cost. The original strategy's best trade made $573. A long trend run that kept going and going. With a 100 pip take profit, the same trade exists at plus $100. We had left 473 on the table. That's the trade-off. We gave our biggest winners to protect our against our biggest losses. And the data says that trade-off is worth it. Plus $169 more profit overall and dramatically lower risk. This is the episode where backtesting meets the real rules of real money. Sometimes making a strategy less exciting, capping the big wins, actually makes it more fundable. Less drama, more consistency. Hit subscribe if you want to see what happens when we actually attempt this. So, is this strategy perform ready? Claude's honest answer yes, with this change. 2.4% max drawdown gives enormous breathing room under the 10% limit. No time limit means our 1.5 trades per month isn't a problem. Plus $28 over 3 years translate to roughly 17.65 per month on a small account, which scales up significantly with the dynamic position sizing. One idea Claude mentioned for later. Instead of fixed take profit, what if we use a trailing stop? Lock in the 2 is to 1 protection on the downside, but let winning trades run further when the trend continues. That's something to explore down the line. For now, this version is locked in our EURUSD 1 hour strategy alongside with the combined SMA and EMA system we built for the faster time frame. That's episode 10. 10 episodes ago, we asked Claude to build a simple moving average bot. Today, we are comparing our backtest results against real prop firm rules and asking whether any of this actually translate to fundable money. The answer today is yes, with adjustments. Always with adjustments. 8.5% to 2.4% drawdown, plus $628 over 3 years. No time limit to worry about. Episode 11, we bring this together with GBP JPY and Euro JPY into the full multi-pair portfolio and run the numbers on what passing the 5 percenters challenge could actually look like. See you on Sunday.